All right, good morning, Alta Realty Group agents. This is Kevin Lauren. I'm the Director of Training and Marketing here. And today we have some special guests. We have Brandon. Good morning, Brandon. How are you doing today?
Good morning. I'm doing well. And yourself?
I'm doing well. And Brandon also has his associates with him. And so, Brandon, tell us a little bit about your company. And also, if you guys want to share your screen, you can go ahead and do that. But yeah, give us a little background on what you guys do.
Yeah, that sounds good. Well, everyone, my name is Brandon GARVA. It's nice to meet you all. I'm a financial advisor with Principal Financial Group. We specialize in working with small business owners. We actually lead the industry when it comes to defined benefit compensation plans, non-qualified deferred compensation plans, and employee stock ownership plans. We're also a key player when it comes to group benefit plans. So needless to say, we work with everybody across the board. It doesn't matter what chapter of your life you're in, we're here to help. But specifically, we really focus a lot of our attention on helping business owners succeed, overcoming any type of hurdles that they may face as they go through the different stages of their career. That being said, we're excited to be here with you guys today. We have a lot of great content. I wanted to make sure that I brought you guys the creme de la creme. So I asked my colleagues, Jeff Golan and Elias to join us here today. And they're going to go ahead and give you guys some really valuable information that I'm sure will help you with your businesses.
Awesome. All right. And let's see, I'll unmute both of our speakers. Or I guess you guys may need to unmute yourselves if you can do that.
Yep. Hey, it's Elias. Good morning.
Perfect. Good morning, Elias.
I'm going to be in the background, but I work with Brandon. I'm managing director here with Principal, and I'm up in Costa Mesa. Brandon is our advisor in San Diego, or one of our advisors in San Diego. And then I've got Jeff Golan here as well, and Jeff's going to do the majority of the presenting. So Jeff, I'll hand it off to you.
Let's see if we can unmute Jeff. Jeff, you may need to unmute yourself. Let's see, Jeff, are you able to unmute yourself, buddy?
Can you hear me now?
There you go. Okay, perfect. We can hear you, Jeff.
Okay, I apologize. Let me just start over. Thank you for the opportunity to talk to you guys today. What we're going to do is really cover a complicated subject from a very high level. So if any of this is of interest to you, I would encourage you guys to reach out to Brandon and set up an individual conversation. And what we want to talk about is, as real estate professionals, what options are available to you to save money on a tax favored basis towards your individual retirement security. And so what I wanted to do initially was just start off with the most basic plans, and then slowly building up layers of complexity to show you options about how you can actually save more money towards retirement and reduce your current income tax liability. Now, having said that, one of the variables is, whether or not you are self-employed and filing your taxes on Schedule C, or whether you have incorporated. And so there's going to be some subtle nuances and differences. So I want to caveat what I'm about to share with you guys with saying that this is going to be a general description, and for individual, advice, work with your local tax professional and reach out to Brandon, and then we can give you the specific numbers. The most basic form of retirement savings for self-employed people is the individual retirement account, IRAs. We're all familiar with IRAs. And so for 2020, you can save up to $6,000 in an individual retirement account. And if you're over 50 years old, you'll get a $1,000 catch-up. So that means in total, if you're over 50, $7,000. Now, there are phase-outs about who is eligible to contribute to an IRA. And so as a general rule, if you are filing single, at $125,000 of income, that starts to be phased out, and at 140, if you make over 140, you can't contribute to a Roth. If you're filing jointly with a spouse, then that's 200 of income where the phase out starts to happen, and about 206 where you can't contribute to a Roth. I'm sorry, to a traditional IRA. Traditional IRA is what I meant to say, not a Roth. So if you are below those thresholds, then you can, right off the top of your earnings, you can contribute up to $6,000 and plus a $1,000 catch-up. That's pre-tax deduction. Earnings will occur tax deferred, and then you'll pay ordinary income tax on the back end. The next kind of complement to the traditional IRA is the Roth IRA. And the rules are basically the same. It's a $6,000 contribution limit and a catch-up at $1,000 with the same phase-outs. Now, the way the Roth works is you can't deduct the contributions going in. You won't pay tax on the growth, but you will not pay tax on the back end, on the distribution side of things. So with the traditional IRA, it's ordinary income on the distribution. With a Roth, there's no tax on the distribution. So the younger you are and the more time that you have to let the miracle of compound interest work to your advantage, the more sense a Roth makes. So between those two accounts, that would really give you, $12,000 to $14,000 of contributions towards your retirement savings. The next type of plan that I want to talk about is a simple IRA. So the simple IRA is a form of IRA that simple stands for Savings Incentive Match Plan for Employers. And as a self-employed person with a simple, you could put away up to $13,500 tax deductible, plus if you're over 50, you'd get a $3,000 catch-up. So where a traditional IRA would get you, if you're over 50, would get you up to $7,000 deduction, the simple could get you up to $16,500. With no material changes in cost or complexity, it's just the type of plan that you choose to adopt for yourself. Now, once we go above the simple, then the next type of plan that most small business owners and self-employed people look at is a SEP. Now, the way that a SEP works is you can defer 25% of your total compensation up to $57,000. So say, roughly speaking, if you're making about $230,000, you could theoretically defer $57,000 into a qualified retirement plan for yourself and deduct it right off the top. Now, if you are Schedule C-ing your income versus having some type of corporate entity, there are some minor adjustments that need to happen for things like payroll taxes and how much you've actually paid yourself. So this is where my caveat that I'm oversimplifying things comes into play. But just know that with a SEP, you can defer up to 25% of your earnings. Okay? So those first four plans that we've covered, the traditional IRA, the Roth IRA, the simple IRA, and the SEP, those are basically very, very low-cost, readily available options that Brandon can help you with if you're interested. Now, there's some more types of plans that I want to discuss with you, and these are more of what we call qualified retirement plans. Now, with a qualified retirement plan, you can get a larger deduction, but the trade-off is there are some initial setup fees and ongoing fees to maintain the plan. So to get to these higher levels of deductibility, it's going to be more of a cost-benefit analysis. And so everything we've covered up to this point is pretty simple, plain Jane. And now, if you want to get bigger deductions, note there's going to be some minor fees for the ongoing administration of the plan, but we can get you to even larger levels of deduction. So the next plan that I want to talk about is what's called an individual 401k.
Jeff, let me interrupt you real quick here. First of all, just wanted to remind the agents on the line that we do have a chat feature, and if there are any questions, go ahead and post any of those questions. And then also, I do just want to make sure that I bring on Bill Seitz, our CEO of Clearview Mortgage, and I want to make sure that Travis Breton also can come on and ask any questions as well, just to make sure that those. Travis is the guy that brought this group of gentlemen to us, so. Of course, we want to make sure that if Travis has questions, he can ask questions as well. All right, go ahead, Jeff.
Yeah, no, I'm happy to accommodate. So now with an individual 401k, what you can do is you can defer up to $19,500 of your earnings what you pay yourself. And if you're over 50, there's a catch up of another 6,500. So of your own earnings, you could actually defer up to $26,000 into the individual 401k. And then as you look to your Schedule C earnings, you can actually contribute another 25% of your Schedule C earnings up to that $57,000. So the individual 401k will give you a little bit more flexibility than the SEP to contribute your own personal earnings as opposed to coming off your Schedule C. But still, the limit on all the what we call defined contribution plans, where you put in an amount of money and whatever it grows to, it grows to. For all plans, whether it's a SEP or an NDK, that's going to be $57,000. Okay. The NDK will have an initial setup fee and an ongoing maintenance fee, as I mentioned, and maybe just to give you a ballpark sense of what that is, maybe it would be around a couple $1,000 a year, with maybe like a $1,500 setup or so. Now, if you're making a significant amount of money, and I know that the real estate market in Southern California especially has been very, very good and very, very hot, and you're looking for even more deductions, the next thing that we can do for a self-employed individual is we can actually set up a pension plan. So for most people that are working in the private sector today, pension plans really are a thing of the past. They're really primarily thought of as benefits for public sector employees like teachers and policemen and firemen and government officials to retire on a full pension. But if you're self-employed, you can set up a pension for yourself. And when I mentioned the Roth IRA and said the younger that you are, the more the benefit is, the pension is the exact opposite. The older that you are, because you have less years until retirement age, the more you can put away. So for example, if I wanted to set up an Indy 401k and put away $57,000 and I still wanted to put away more money, if I'm about 30 years old, I can put away an additional $60,000 into a pension plan that would give me a guaranteed retirement income when I retire. So now we're looking at about $120,000 of total deductions. Now, if I'm 40 years old, that deduction gets to be $100,000 because I'm 10 years closer to retirement. So that gives me about $160,000 of total deductions. If I'm 50 years old, that defined benefit contribution deduction that I can make is more like $170,000. So all in between the two plans, I'm looking at about $200,000 of deduction. So, depending upon your situation, depending upon your desire to create current income tax savings, and depending upon your income, we've quickly gone through several different plan options that you can get anywhere from $6,000 to potentially $225,000 of deductions. So I'm not sure if you guys have any questions that we might be able to briefly answer. We'd be happy to do that. But I would suggest again, if any of this stuff is even of interest to you, what I would suggest that you do is reach out to Brandon, tell him more about your individual situation. And how we typically get to the answer is not trying to tell you what plan you should have, but the conversation starts with, how much would you like to put away? How much would you like to put away pre-tax? And then given that, we can guide you towards the right answer. Some of these plans are very fluid and flexible. On a year-by-year basis, you can determine if you want to make a contribution. If we're talking about those pension plans where we're looking at significant contributions, there is an expectation from the IRS's perspective that you at least have the intent to contribute to them for a few years. And then if things change and your profitability isn't what it currently is, you can always terminate the plan and wind it down and then roll out whatever's in that plan into an IRA for yourself.
Great.
So with that, I'll be quiet, and if you have any questions, happy to answer them. Otherwise, we can pass it back to you guys.
Yeah, I don't see any questions in the chat. Travis or Bill, do you have any questions at this point?
Good morning. This is Bill. Thanks, guys, for the information. I think this is I don't really have any questions per se in the broader sense, but I do think this is a really good topic for our profession because, as we all know, we're not W-2 wage earners. We're all basically operating our own small businesses and in that capacity. And we a lot of times don't get access or get this type of information regularly. So it is something for us to consider for our careers and for our retirement. And I think it is a very valid topic that we need to really think about in the big picture, because nobody wants to retire with zero in the account.
No, it's not going to work out very well for us. So.
Yeah, and
Yeah,
if
and
I
I
could
wanted to
add,
bring them up. Sorry, go ahead.
if I could just add, we've worked with a lot of real estate professionals over the past, and we understand that, you guys, really know your local real estate market, and to the extent, there may be like investment properties and pocket listings and things of that nature that you guys want to jump on. We're not suggesting that that's not a good business decision, but at the end of the day, as financial planners, one of the things that we preach to all of our clients, irrespective of the nature of their business, is you don't put all your eggs in one basket. So I think it's a little bit of a balancing act and saying, hey, if you guys want to, develop a portfolio of investment properties and do that kind of stuff, absolutely. But the combination of tax savings and diversifying out of real estate as an asset class, this is something that everybody as a real estate professional should at least consider.
Yeah, I wanted to bring you guys on because I do get asked a lot, as a broker, like, what kind of deductions can I do? I'm making a lot of money, and I don't have the answers to all that. I'm a broker. I'm not a tax person, So I think it's good that not everybody stays focused on what can I deduct, but what can I save as well as deduct to lower the tax base that they're paying on. So I think that this is a really good vehicle for a lot of independent contractors and small business owners that just, I can say, I don't think a lot of them really take advantage of or know that they can have these extra savings accounts for retirement.
No, you're right, Travis. So that's exactly why these gentlemen are here with us today. No, that's a good point.
Yeah, I couldn't agree more. Just to kind of chime in, to give you guys a little bit of background on myself, I actually started in the real estate industry in 2003. And, I spent 15 years in the industry as a realtor, a loan officer, a loan processor, a notary public. I've played all the different roles in the industry. And part of the reason why I am where I am today with Principal is because back in 2017, when I had my first child, I found myself in this moment of uncertainty because I had been self-employed. My commission was always, up and down. As you guys know, you go through waves, you go through the seasons, and there's the feast or famine mentality in the real estate industry. And I found myself in a position of, uncertainty, not knowing what I was going to do for my future as far as preparing for, my kids with college and retirement. And all of a sudden, all those family thoughts, start tying in with the business thoughts. And I realized that I never really had anyone to show me how to prepare for the future. And that led me on a path of exploration. And as I went deeper and deeper down this path, I found myself becoming more and more passionate about understanding how to prepare for the future, how to manage your money, how to utilize the right vehicles for, ultimate efficiency. And that led me to finding Principal Financial. I want to find a firm that could help me not only solve my own problems, but then turn around and help people such as myself, like-minded individuals that were in the same boat. And again, that's part of the reason why we're here today. I know Travis, and thank you so much for bringing us on board. We understand what you guys go through. We understand that there are ups and downs, and it's easy to spend the money and say you're going to put things off for the future when the money's coming in, because once it starts rolling, you think, okay, we're good, everything's going to be fine, I can take care of this down the road. And then that time doesn't always come. And I got to tell you, seeing firsthand, a lot of people I network with are in the real estate industry, and I've helped quite a few agents where they do very, very well for themselves, and they've been around for a long time. And when it came time to sit down and look at their finances, they weren't in the position that you'd think they'd be in, And so I love that saying, proper preparation prevents poor performance. And that's part of the reason why we're here today. We want to make sure that we can help you guys with setting yourselves up now before it becomes too late. So if anyone does have any questions at any time, feel free to reach out. We're happy to help. everything we do is we're here to serve you guys. So, if you even want to just give us a quick, synopsis of what you guys are looking at right now, we can kind of help guide you as far as what the next steps might be to make sure that you're on track with hitting your goals, not only on a personal level, but on a professional level as well.
Are you guys located geographically up and down the state, or just primarily Southern California?
Well, we're actually located all throughout the nation. I personally am located in San Diego County, and I work with clients all over the county, but yeah, we're spread throughout the country.
Okay, cool. Because I don't know how much you know about our company. We do have agents that are regionally, located from Sacramento down to essentially the border. So we have a real diverse agent base as far as which communities they serve. So if that's just how we're kind of set up.
That's a great question. Yeah, no, we're able to help anybody and everybody. It doesn't matter where you're located in the U.S. If you have questions, we can assist you.
Hey guys, this is Jeff. Could I just add one more thing? I know that the past year has been, pretty difficult, cash flow wise. And so, if you've had a good income year, but maybe you don't have, strong cash flow now, still reach out to Brandon because, some of these plans, you don't actually have to fund the plan until, you file your taxes. So, we can still get you some pretty good deductions. And in some instances, we can actually defer the funding until, September, October of 2021. So some of the plans work that way and some not. So my advice is if you're, interested, at least reach out to Brandon, and then we may need to put some prototype plan documents in place before the end of the year, but still wouldn't have to actually fund your retirement plan until sometime, towards this time next year. So just know that you don't have to come out of pocket if you're still looking for that deduction right away.
What is the end of year deduction deadline? Is it December 31st?
Well, it depends. So some of the simpler plans that we talked about, you really have until April of next year to actually fund. But the more the 401ks and the defined benefit plans, we need to actually notify the Department of Labor and the IRS that the plan exists. And so we have prototype documents that we put on file with them that we've got to put on place before the end of the year. And then we can worry about the details next year and not have to worry about funding them until, basically like September next year when we actually file.
Got it. So there's a little front end work on some of the plans.
Yep.
Okay, excellent.
I'm sharing Brandon's contact information, but if anybody's dialed in, you can reach Brandon. I'll give you a cell number. It's 760-390-8249. 760-390-8249.
Yeah, and of course, when I put out what I do, guys, is I put out a replay every time we do a webinar. So I'll make sure that information is, of course, in the replay, in that email that I send out to everybody. So you'll all have Brandon's information.
Appreciate that. And then one more thing I want to throw out, of course, we're happy to be here today to discuss this topic with you guys about ways to, minimize the taxes you're paying while preparing for your future. But if anyone ever has any other topics that they want us to discuss, if you guys as a group decide there's another issue that you don't know too much about and you'd like some education, don't hesitate to reach out to us. We're happy to offer our services at any time. That's a big part of what we do is educating people on what type of options they have available to them.
No, that's great, Brandon, because what we really try to do is, make sure that our agents have all the resources available to them. So you guys are a really good resource for our agents. We appreciate it.
We're happy to help.
Good. So any other questions in the chat? I don't see any. Otherwise, please do contact, Brandon directly, and he's happy to help you guys. So thank you for that. Also wanted to just thank some of the new agents for joining us. We've got a new agent that just joined us, I think a day or two ago. His name's Yogesh, and so we're really, really excited to have you with us, Yogesh. Looking forward to working with you. All right, guys. Well, thanks again, and make sure that you get out there, make it a productive week and a good week, and we'll see you guys next week on our webinar. Thanks a lot.
Take care, guys.
Bye-bye.